Hello once again, dear traders and viewers, and as it was announced previously in the economic data release, we are going to discuss U.S. Retail sales month-on-month data. And I would like to remind you that it measures change in the total value of sales at the retail level and is the primary gauge of consumer spending, which accounts for the majority of overall economic activity. So at the current moment, the forecast for January is 0.0%, and the December figure was 0.2%. Retail sales in December suggested a moderately healthy consumer sector, somewhat in contrast to the December employment report. Overall, retail sales in December rose 0.2%, following a gain of 0.4% the month before. Excluding auto, sales posted an 0.7% boost after a November rise of 0.1%. Gas station sales rebounded 1.6% following a 1.5% decline the month before. Excluding both autos and gasoline, sales advanced a healthy 0.6% in December, following a 0.3% gain in November. And the core strength was seen in food and beverage stores, health and personal care, clothing, non-store retailers, and food services and drinking places. January's dip in unit new auto sales may tug down on overall retail sales. So moving on further, it is possible to see the economists from different banks and companies around the world surveyed on the matter. And according to this data, the estimate for U.S. Retail sales, where the median estimate was 0.0%, whereas the average estimate was 0.0%, and high estimate of 0.4%, whereas the low estimate was minus 0.5%, and the number of estimates was 86. And talking about forecast further on, thank you, Special, for moving my slide. I would like to quote Michael Carey, North America Chief Economist and Credit Agricole, that retail sales likely declined 0.1% in January alongside a decline in auto sales. Motor vehicle unit sales declined 1.0% month-on-month in December to a 15.2 million unit rate, which we expect will drag down the top line retail sales figures. Moreover, many auto dealers reported bigger price markdowns and increased incentive pricing during the month, which may be an additional drag on nominal receipts. Some offset may come from 1.1% increase in gasoline prices, which should contribute positively to total retail sales per figure by boosting gas station receipts. Outside of gas and auto, sales were likely softer due to weather impacts throughout much of the country. Weekly reports from the ICSC and Johnson's Red Book reported some slowdown due to weather and at the beginning of the month, and noted that the end of the month was dominated by clearance sales and inventory reshaping, which should keep gains in core figures soft. And finally, moving to the fundamental aspect, the impact on the U.S. dollar, Japanese yen. So as you can see, our traders on Dukascopy community were rather bullish on the matter. That is 69.23% bullish versus 30.77% bearish. And one of our bullish comments by a community member stated that last time we saw a drop in sales and consumption figures, but it was mainly because of bad weather conditions, expecting a recovery in this release. And as you can see, the bearish comment by Carpe that high volatility expected will be released at the same time retail sales month-on-month and continuing an initial jobless claims data. Besides forecast optimism of retail sales month on month of core retail sales decrease, forecast comes true, and here will go down. Bearish impact. And that was kind of it from my side, guys. And right now I would like to give my word to Alex, who will cover up on the more technical matter. So Alex, my word to you.
Hello everyone. So today we are discussing US retail sales as well as we are having a release of US unemployment claims as always on Thursdays. And as Pauline already said, the data is expected to deteriorate in January. However, we should also not exclude the possibility that both figures can surprise markets to the upside. Hence, the greenback still has a potential to appreciate. Therefore, our positive surprise trading strategy is based on United States dollar Japanese yen currency pair, and as we see that during the last week the pair has been strongly bullish, and after reaching this year's low around 100, to be more precise, that's 174 level, and it was actually the levels reached on February 4. Yeah, the pair began its appreciation and currently it's trading around 101.93. So the positive surprise trading strategy, as always, with the entrance point at the market price. The potential take profit is recommended to place around weekly support and just slightly above recent high at the level of 102.24. Here it is. As to the stop loss, first of all, I decided to place it at 100.197, right at the level of weekly pivot. However, we see that during the last couple of minutes the pair has been strongly bearish and it has already penetrated this level. Therefore, the next potential stop loss is recommended to place at 101.87, and to be more precise, that's 2 days low, while the key support for the short traders can be found at 101.91, just 6 pips below the potential stop loss. And actually this level is represented by daily support, and we see that recently the pair was struggling to move any lower from this level. So yes, in a short-term perspective, it would be really difficult to push the pair any lower than this level. But once again, the potential take profit can be placed at 102.24, while the potential stop loss is placed at 101.97. So here we go. And why actually I have chosen this pair for the positive surprise trading strategy, and the main reasons behind it: the strongly bullish market sentiment, and we see that Dukascopy traders as well as Saxo Bank, Oanda, and daily fixed traders are buying the pair in vast majority of all cases. And to be more precise, Dukascopy traders are holding long positions in more than 72% of the time, while Saxo Bank, Oanda, and daily fixed are buying the pair in 72, 61, and 64% of the cases respectively. Yeah, as always, let's have a look at currency index, and we see that attitude towards the greenback is strongly bullish, as American currency is bought in more than 65% of all cases across the board. Meanwhile, Japanese yen is slightly bearish, as Japanese currency is sold in 57% of the time. And last but not least, we see that vast majority of pending orders is also placed to buy the pair, meaning that even in the longer term, the pair is expected to appreciate. However, I would like to stress out that when having a look at technical indicators, we see a completely different situation, as indicators only on 10-minute chart are send buy signal, while indicators on the 30-minute, hourly, and daily chart are suggesting the pair will depreciate in the medium and short and longer term. However, so last but not least, I would like to point out that MACD indicator on the variety of time frames is suggesting that the market is oversold already and will see some movement to the upside in the nearest future. So I guess just 5 minutes left before the news release, and we see that the pair is approaching the potential stop loss, and currently the pair is trading at 101.90 level. So I guess that will be all from my side, And I'm giving the floor to Thomas, who will discuss the negative surprise trading strategy, as well as he will have a look at the market reaction. So, welcome, Thomas.
Alexander. So hi everyone, I hope you're having a great Thursday. Let me just put my slides on the whiteboard. So what you're seeing at the moment, or should be seeing in a few seconds, is Australian dollar, United States dollar, 1 hour chart, just to illustrate the situation in the markets. As far as I understand, oh yeah, here it is. So you can see that we saw a rather substantial sell-off in the Aussie United States dollar, which depreciated around 100 pips in a few hour period, and in my opinion that adds a little bit to the idea that we might see recovery, which is seen actually already, and might add to the probability of reaction, as the traders might be already pricing in and preparing and positioning themselves for the negative news from the United States, in which case the Aussie would benefit against the greenback. Now, there is not so much support for the Aussie, I guess, as in Alexander's case, the main idea being that the current market sentiment is moderately bullish. 63% of traders are already long on the pair, meaning expect further appreciation of the pair. 2 out of the 3, say, other market participants on the daily FX, their clients, their traders actually also bet on the further appreciation of the Aussie. The only Saxo Bank clients, there's 60% of them are bearish, expecting depreciation of the pair. So now if we move into 1 minute chart, you can see that currently it is for the past, what now, I guess hour or so, has been trading around a little bit more than hour and 20 minutes, has been trading above the 20-minute simple moving average. Therefore, the stop loss is put slightly below it, although it would pretty much rather safe to put the stop loss at the 200 bar simple moving average, at the moment located at 0.89614, which is 4 pips below the current market price. And for those expecting further negative news and therefore reaction, bullish reaction from the pair, I guess it will be a really safe bet to enter rather safe one to bet to enter the position now and go long on the pair, because the peaks above the current high, the recent high, which is located at 0.89667, might prove and be found to actually dip further on. And the take profit is located at the daily S2, which is in the moment is 6.5, almost 6.5 pips above the current market price. And what we have now, 1 minute return till the release of the data. So I guess we could look into the technical indicators. All right, what we're seeing, you can see that in more shorter horizons, like 10 minutes and 30 minutes, technical indicators which are constructed to show at the trends of the pair actually give bullish signal and point at appreciation of the pair, and we don't really see any warning signs from the RSI or stochastic indicating that the pair might be overbought at the moment. So we are having, what, 20-something seconds till the release of the data. Once again, enter long the current market price, stop loss at the 200 bar simple moving average at 0.8961, or a little bit lower at the, let's say, in a sense, major level at 0.8960. And also take profit at the daily S2, 0.89726. Okay, so let's zoom in. What do we have now here? The pair is currently trading at the 0.8965. We see no market reaction yet, although the data should be coming out any second now. So yeah, we are seeing the pair has appreciated by 2 pips just before the release of the data. Okay, so what I'm seeing is unemployment claims slightly worse than expected, right? Which is at 339,000. So you can see, I guess, as it came out only 8,000 worse of the expected. You know, when the overall level is 300,000, I guess that's where the well, few minutes ago, what 4 pip appreciation coming from. And let's see what the retail sales will bring us. As far as I understand, yeah, 339, and we can see that the pair is continuing to appreciate. Current gains actually 6 pips, and it is approaching the take profit level, which is now just 2 pips above the current market price. Retail sales. So yeah, retail sales came out worse than expected, I guess. Although core retail sales might have the biggest impact. And what is a little bit surprising that we see a bearish reaction of 7 pips on these numbers. However, it should push the Aussie lower, and it already dipped below the 200 bar simple moving average. And yet, once again, we are having a little bit contradictory numbers and contradictory market reaction. So we saw almost 5 pip reaction, bullish reaction on the unemployment claims, which came out slightly worse than expected. Slightly worse than expected retail sales, mainly, I guess, the month-on-month basis, right, which came out 0.4% worse than expected, although they already predicted 0.2 decrease. And the Dukascopy, which in the level which actually speaks about the weakness of the United States dollar, and we can see that core retail sales came out 0.1% worse than expected, which is a 0.7% decrease from the last month, and this caused a 9 pip bearish reaction from the market, and it seems it's currently consolidating around 0.8965. In my opinion, that will be pretty much all we could expect. Maybe, you know, some short-term dips here and there, but it's very hard to evaluate. Maybe there is something I am missing from here, because this doesn't really correlate well with what the data came out. So I guess that would be all what could be said at the moment. Maybe Doc Dow has a comment on what is going on and why it is going on. And yeah, at this point, I just give floor back to you, Polina.
Okay, thank you very much, Thomas and Alex, for presenting the technical matters on the retail sales. So, Doc Dow, any thoughts and ideas on the numbers?
Yeah, the reason first of all, the reason it was hard to even spot them coming out is that I think someone's doing it from their kitchen table at home. They're routing through some type of server, and they didn't release them normal because of the snowstorms. The snowstorm is between here and like Montreal. I mean, it just goes, you know, or not Montreal, but up into Maine at least, you know, up into the Canadian border. Anyway, the numbers, a little surprising that they were even more weak than was expected. Autos and so forth were flat versus last month, where the autos showed some life in them. And so it just shows the weakness in the U.S. economy, no confidence. It's the constant same story, same drumbeat. You know, some numbers come out making some sense, some good sense, and then we have numbers that out of the same story that make no sense. And so pretty much where we're at the moment is that, you know, the numbers are just telling us that overall we're in a lethargic economy. It's systemic across the planet. There is no real pocket, I guess you could say there's not like a, you couldn't look at like, say, England or Lithuania or, Romania, or you could, point a country out and say that they're doing much better or worse than anybody else. And you can tell that from their, the 10-year bonds and the way that the interest rates are being floated. Overall, it just, the numbers just keep on reflecting that we're stuck in this, I guess it's a zone. Someone was saying in one of the webinars a couple hours ago that we're pretty much locked in a zone, and that the central banks, have us locked in a zone, and they hope that we heal. In other words, we as a world recuperate and grow and become healthy again. And so, when you look at the jobs numbers came out this morning, they're just flat, no excitement either way. And then at the same time, you look at the retail sales and you see the retail sales dipping, and then you get a little crazier and you look at the U6 on the labor report versus, say, the U1, and you have 13.1%. And then you take the dart again and throw the dart at the dartboard of the world map. And who can really claim that they're having great employment numbers? The employment numbers are, just sideways, going nowhere. A lot of people unemployed. So unfortunately, again, we're witnesses, or like the night watchmen, kind of watching the numbers. Thomas and I and a bunch of us all watch the numbers, and we see good numbers, and then we see bad numbers, and it just goes back and forth the same way. Do you read it the same way there, Thomas? Yeah. It's just it's the same story everywhere. So I guess, good, Thomas.
I must agree with the general idea. Just my question was about the overall storms. I guess just the initial idea. Do you think they might have a little bit negative impact on the next week's data? And that's pretty much. But I overall agree with your attitude. And
right. They were trying to find that last. Was it out of last month's statistics? They were calling it the. They have a name for it over here. I'm trying to think of it because it makes no sense, but they have a name. Winter vortex. The winter vortex. VORTEX. And they were trying to basically see if that had some type of statistical value in December's numbers and in January's numbers. And so far, they don't seem to. For every number that seems to say, oh yes, things are a little slower because of it, we're seeing also numbers that are perking up that shouldn't perk up. They shouldn't be lifting. So again, we're trapped constantly in that same situation where one number gives us a good signal and another number gives us a bad signal. We just get constantly, in the end result is that everything is basically in a sideways chopping pattern. You play the top of the ranges, you buy the bottom of the ranges, and you hope for for them to stay inside the range so that you're right. I guess that's about that, except from Ice Station Doc Dow here, where we have now 5 centimeters of snow. They're saying that we could have as much as a whole meter of snow today. A whole meter. We had half a meter on the ground already. I mean, you open the door, there's a half a meter of snow already there. This morning we're going to get a whole other meter of snow. So I would assume that the March numbers should start to reflect some of this. Let me throw this at you too, Thomas. If you noticed, in the United States, the internet sales are very high right now. In other words, the growth is around 15%. And you see a lot of retail sales going on through the internet more than you do what they call the brick and mortar. In other words, walking into the buildings. So, I would imagine that is one of the reasons why the numbers are not as dire in December and January from the bad weather. And that's probably something to take a peek at, trying to play around with some of the numbers. I would recommend also to look at UPS, United Parcel Service, and their breakdown of their earnings and so forth. That'll show the delivery, because UPS and Federal Express, FDX, are the two major deliveries of the internet sales, and the numbers are growing dramatically. I saw a 15% increase last year which is a pretty big number. So I don't think we can point out too much on the planet that's doing 15% growth in anything. And that is it from Doc Dow from Ice Station